Hey everybody, just a quick update on the markets. So today marks the start of quarter four, and it is the second last trading day before we head into the Labor Day long weekend where markets are closed in North America. So with that in mind, I want to touch base on a couple critical things. So first off, oil. The price action recently in oil has been tremendously to the downside. Now, that is a good thing for consumers since it is bringing down our energy costs, inflationary energy pressures, and of course gasoline, which everyone appreciates, cheaper fuel. So with oil recently declining, we have to analyze and factor in why it has been on a decline. And there's a couple key things that I can think of right off the bat. One, you can't be fighting the Biden administration when they're releasing another 180 million barrels from the SPR, the Strategic Petroleum Reserve. So that is a way that they're stimulating the economy by making gas cheaper in the short term. Now, there's going to come a time where we deplete the reserves to a level that we have not seen, and that's currently what we're doing, which is actually going to create more inflation in the long term. So it's actually a very, very bad policy decision in my opinion. So the second factor as to why we should be so concerned with oil declining. If people are factoring in, energy traders factoring in a global recession, and that's certainly what the price action is looking for, it means that oil, the most used energy and commodity in the world, is signaling to the market that things may be taking a turn for the worse. And that's certainly how we are positioned heading into the end of this year and quarter four. Now, with that in mind, many of the stocks have been beaten down over the last week. And when you factor in, some stocks took about a month to 2 month rally over the summer and have completely given back all of those gains. They have been crushed. So one of the reasons the markets have been under such immense pressure, and we have been touching on this with our members for a long time and prepared for this price action, is certainly the US dollar. The US dollar surging is a form of tightening on the whole world. And the longer the US dollar stays elevated at these lofty levels, and we're talking about the US dollar reaching levels that we haven't seen in 20, 22 years, 23 years. So it is an exceptional move and trend that is now forming in the currency market. And the longer the dollar stays elevated, the more constraint it has on global production and global growth. And that is never a good thing if you're a country outside the US, because it will put an inevitable pressure on you to service your debt, create more expensive, and it could lead to a sovereign debt crisis. Whenever the dollar has reached these lofty levels, there has been a 100% correlation to a massive crisis in the form of a credit sovereign debt crisis. So the last 9 times the US dollar has reached these levels, we have had a tremendous amount of pain in the investment markets, and that's across every single market. So as statistics show, when you have a 100% correlation that has been proven 9 out of 9 times to be correct, that is a strong statistic to ignore. You certainly have to be aware of what could transpire and what is likely to transpire. So overall, the price action in energy is not a good signal, despite it will help consumers in the short term. The dollar surging is never a good thing for anybody outside the US, and it's kind of very counterintuitive. People would think, oh, inflation is the highest it's ever been in 40 years in the States. You would think it would be putting pressure on their dollar because they've printed all this money, they're devaluing, but the dollar is actually still the strongest when you compare it to all of the other mess that is going around the world, especially in the Eurozone. So overall, if there is some sort of a debt crisis or credit crisis, none of your investments are safe other than shorts, cash, and that's pretty much it. So be aware of what could transpire over the coming months, and specifically as mainstream news start to pick up the fact that we are in a global recession heading into 2023.